Welcome to the Oxen Group Nightly. My name is David Ristow. I'm the president, CEO, and founder of the Oxen Group. The Oxen Group is a financial analysis and investment ideas blog and website. You should check us out at www.theoxengroup.com. And welcome to the Oxen Group Nightly. This is a nightly video that we do that features market wrap-ups and talks about some of our current positions, as well as looks at what's going to happen in the market in the coming days. So for tonight's episode, we're going to be looking at the market wrap-up of what happened on Wednesday. We'll also be talking about our new recommended position in Dick's Sporting Goods. We'll also be looking at our double dipping into Apple today. We'll be talking about some of the other positions we're looking at. We'll be discussing our long-term rating update. We just put it out today on Skechers, and we will also be looking at our tomorrow's forecast. So today the market seesawed up and down and really was trying to find a direction with a combination of good economic data, some good company news, but at the same time higher oil prices. And so you have these sort of positive catalysts to the market on the economic side of things, but then also some negative catalysts to the market on the commodity side of things with oil. So the market sort of seesawed back and forth throughout the day. Crude, settled at its highest level since 2008 today, but at the same time, the ADP private employment report announced that private employers hired added 217,000 jobs in February. So it's kind of this duality of good and bad news, and the market sort of seesawed back and forth trying to figure out what to do. And oil prices continue to rise. Libya tensions escalated today. There was news about Gaddafi dropping bombs in oil-rich areas, trying to get control of oil. There was talk about there's tensions maybe rising in Iran and Oman. There's issues in a couple other, maybe there's going to be some issues in Morocco as well. And so the Middle East seems kind of like a powder keg right now, just waiting to go off. And that's really going to affect the price of oil. But at the same time, the market sort of showed today that maybe we can survive with higher oil prices. As we see here on the chart of the day, you see in the morning we are rising, 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 and as oil continues up, at some point, as it broke 100, it sent the market back down. But once the oil had settled at 100, the price had settled at 100 and was trading then in between the range of like 101 and 102, the market starts to trend back up. And then it broke into above the 101 level, it trends back down, and then as it got to the 102 area, we traded back up. Now we sold off at the close. Doesn't really mean that anything to me, but it was good to see that the market was able to fluctuate up and down with oil throughout the day and at least show some signs of strength despite higher oil prices. And if we can see that the market's going to be able to be strong on good economic news while oil prices may increase, then that seems like a bullish case for that the market can continue higher and maybe won't be pulling back so much. I was looking at some data today, and actually March is a really high month for a lot of retail investors, a lot of hedge funds, a lot of mutual funds to reinvest a lot of money in this month. And a lot of them have been waiting for some kind of pullback to happen in order for them to get back into the market. Well, we've had this pullback, and now there's a lot of stocks that are undervalued. A lot of things connected to oil, like in the retail sector, the airlines, transports, they're all really undervalued right now, and they present some really great buying opportunities. And we took advantage of that today with Dick's Sporting Goods. We entered a recommendation today at 36.53 for the position for our members. And we think the company has a number of catalysts working in their favor in the next couple of days. For one, as we'll show in a second, the technicals are outstanding for a definite rise on the stock. But we also see that they have earnings coming out next Tuesday morning, and those earnings are expected to be pretty awesome, basically, compared to what they've done. They're supposed to have maybe their best quarter of ever. EPS breaking the 0.70 level, well above what it was 1 year ago. And they also have a number of kind of rival or similar companies that are also reporting earnings that could help out. Foot Locker tonight beat estimates slightly and was up a little bit in after hours. You also have Hibbett Sporting Goods coming out. Finish Line is not going to be out right now, but that's coming up in the future. And so a number of companies are going to be reporting earnings that are in similar areas. And then also throughout the retail sector, we've got a number of apparel goods stores and that are also going to be reporting coming up. And then you also have retail sales coming out tomorrow, and some may be coming out on Friday. And those will also be bullish for the market if they're good, and they'll be bullish for Dick's Sporting Goods. So you got a lot of factors coming into it, and a lot of that looks like it's going to be good. A lot of upside to those things. Um, and with the chart we see here, with where Dick's Sporting Goods is right now, it seems like a really nice time to buy into it. You see, the first thing that I noticed about this chart is that it has a really nice support line at 36 over the last um, week or so here. And despite the pullback that we saw last week, the stock really only broke 36 for a little bit of time during one day, but was able to settle back up higher. And I think the real key to this is that that support line at 36 was not broken at all. You also see the Bollinger Bands narrowing. What that tells me is that this stock is narrowing and then it's going to break out again. You see other times when the stock's narrowed over a 4 to 5 day period, that you see the stock kind of trade at a very narrow range and then break out. Um, it happens again here, broke out down. It happens here a little bit longer, breaks out. So anytime you see these Bollinger Bands coming, narrowing in, it means that the stock is getting ready for a breakout, or it's going to break out because the volatility has decreased over the last several days, and those bands start to narrow. But as the volatility starts to narrow, it reduces the trading range of the stock, and then that means that either buying or selling is going to occur whenever those bands get closer. And what we're seeing right now is if you had to pick which way you think this is going to go, would you say up or down? Well, you see the fast stochastics are separating, trending up. You see RSI is trending up, bouncing off, a pretty significant low for it given over this year. And you also see that kind of that some of that fundamental data that's coming out. So we think that this was a great place to get into this company, getting in at a low, right at a support line. You see it broke the exponential, or excuse me, the 50-day moving average today, right at that exponential moving average. If this stock can get a little bit of support tomorrow in the morning with a decent day, we think that it could really take off. We're already up about 1.6% on the position, and we think we can get at least 3 to 5% on it before earnings. We also double dipped on Apple today. I thought this was a great day to get back into Apple, given the fact that the iPad 2 was coming out, given the fact that there was some rumors that maybe Steve Jobs would be at the presentation, and I think they just killed it. I mean, everything that a lot of people had wanted, it was there, was with the iPad 2. They're starting shipments on March 11th, well above what people were thinking. And while the stock, I don't think priced in exceptionally well today, that news, I think some of it was priced in. You see this gain that it had there. But the thing is that the downside risk is so limited for this stock right now. It's got a great support line here. It didn't break that support line yesterday on a huge pullback, and now it has this great announcement about the iPad 2. And we're going to start to see over the next several days analysts coming out giving their take on the iPad 2. We're gonna start to see, some attention drawn to what could sales possibly be. I mean, Apple even said this year is going to be the year of the iPad 2. I mean, so they're really hyping it up, and this is going to definitely have a big impact. We're also going to get I think, some valuation upgrade from the fact that they're reducing the price of the iPad 1 by 100 points, or excuse me, $100. So I think the stock is in a great upward trend on fast stochastics. You can see the RSI is trending up, bouncing off this low. We bought here, sold here. Now we're buying again, a little bit on the higher side. But I do think that this stock has at least 2 to 4% movement up from this range in the next several days. Other current positions, we made a quick 0.75% this morning on a short sale in Dynegy. This is a company, energy company in Delaware. They've gone through a pretty rough year. Got downgraded to junk status by the S&P. Carl Icahn's bid for the company was denied by investors. A lot of management have just basically resigned, said that this company is going nowhere but down. There's talk that they're going to default on their corporate bonds. So just a lot of bad things going on there. And when the market was, in the morning, we're sure if it was going to go up or down. We picked Apple as kind of a safe haven buy, and then Dynegy as kind of a safe haven short sale, because Dynegy on any given day is more likely to decline than increase given its sort of fundamental makeup right now, whereas Apple would increase. So we were able to make a little bit on both, and we were happy about that. We did have to suffer though a 3% stop on Frontier Communications from our recommended entry at 850. A lot of our members are still in the stock because it momentarily hit our stop loss today. It was the low of the day, unfortunately. But the problem with Frontier is we were expecting a dividend to get priced into the stock that hasn't happened yet. The company hasn't announced a dividend, and the stock dropped significantly after earnings. The only thing that we can say is that what occurred was that the stock held up very well yesterday when the market was declining rapidly. And today you saw, I think, the stock kind of playing catch up, and also the fact that I think a lot of that the stock had made some pretty significant increases from a low after earnings. I think the low after earnings was, I think, around the 818 level. So it went all the way up to 850. It's a nice 4% gain. People that were trading the stock based on that probably took some profits off the table as they started to see it decline, and then it was sort of a compounding factor without a really big fundamental catalyst to take it up. Now, when that dividend announcement does come out, and we were expecting it to come out either today or tomorrow, hopefully hoping for it to be on Friday or on Monday, and it still doesn't come out, so it might be there tomorrow. That's why a lot of our members are still in it, because this stock still could take off once that dividend comes out, if it comes out at the same yield as expected, which is an 8% yield. It's the highest dividend on the S&P 500. And we're also still holding our position in FINRA. That's just an everyday hold that we've had for quite some time. We've reduced our loss to about 4% on it, but we're still waiting for it to pop around the 830, 840 level so we can finally exit it. We also today took a look at our Skechers long-term rating. Going in today, we had a hold rating on it with a price target of $24. After running some numbers, given the quarter 4 performance and some recent developments at the company, we actually decided to reduce our price target to $19. One of the things that we really found disheartening about Skechers is that the company we were always in fear, and we always didn't see the price as maybe ever breaking above 25 again, due to the fact that they had the shape ups, and that really drew a lot of attention to the company and just grew revenue, grew earnings very rapidly for the company. And the market had to play catch up and increase the stock significantly in valuation. But the problem is that the shape ups, like most fashion trends and most fitness trends, went out of style, and it's going out of style. And also that meant that, and it's not something where Skechers could place a real large economic moat on it. In fact, the shape up shoes have actually become almost like a commodity, where the lowest price one is the one that's winning, and Reebok and Adidas have both come out with a cheaper shoe. So in quarter 4, the company scrambled to get rid of inventory as quickly as possible, and it actually ended up creating a real drastic impact on their earnings. They missed expectations. They had to reduce their goals for the first year, and basically at this point it looks like that the shape ups are maybe dead for this company. I mean, they're going to obviously get some sales, increases over what they had before the shape ups were popular, but to expect them to be able to get back on track and to increase earnings over this year in 2012 is pretty much unlikely, and so we don't expect them to be able to really. We think that the cyclical nature of any sort of fashion related company is that they're on the way back down now, and it came faster than we expected. And so that's why we had to drop our price target to 19 now. And it still might even be a little bit high, given the fact that we still think that this company does have some, gas left in the tank throughout the rest of this year with the shape ups, but those could really, really drop off fast. And I mean, I've been criticized on this position because people say, well, the shape ups aren't, the whole business. But the thing about Skechers is that they didn't take the shape ups and leverage that opportunity to create something bigger for the company. In fact, what happened was you basically take the shape ups, you take the moment the shape ups become popular, and you see the company just shoot off. The second shape ups are not popular anymore, they shoot back down, and they lose all that growth, and all that revenue growth that the company saw was in the shape ups sector. So I think people don't realize that, and that once those shakeups disappear, this company goes back to the sort of the remedial, second market shoes that they were before shakeups.